Welcome to Talk Tickers, where we break down the latest earnings calls. And today we've got a really interesting one. Farmer Brothers, ticker FARM. Now on the surface, this looked like a classic earnings miss, but the stock absolutely soared. We're talking nearly 19%. So what in the world is going on here? Let's get into it.
Yeah, that's the big question, right? How does a stock pop like that on what looks like bad news? This is the central puzzle of this whole report. The headline screamed miss, but the market reacted like it was incredible news. So what did Wall Street see that maybe the initial headlines missed?
Okay, so let's put some numbers on this disconnect. The official headline was a GAAP loss of 22 cents a share. That missed what analysts were expecting by about 3 cents. Not great. And yet, the stock just ripped higher. We're talking an 18.9% surge after hours. And look, this wasn't some low-volume fluke. This was a real move. It tells you the market was looking way past that headline number and digging into a much deeper story.
So, where do we find the answer? Well, you have to ignore that one little EPS number and look at what's happening inside the business, the operational story. And what investors were cheering for was a classic turnaround playbook. These guys were executing it almost to perfection, and it was showing up in the numbers that really matter.
All right, first piece of evidence. Check this out. A 610 basis point improvement in gross margin. For those of you not swimming in finance jargon, that's a huge 6.1% jump compared to last year. They landed at a really strong 44.9%. Now think about the environment we're in, with costs going up everywhere. To see that kind of margin expansion, wow, that just screams that they have pricing power and are keeping a tight lid on costs.
And that extra margin? It didn't just disappear. It flowed right down to the bottom line. We're looking at adjusted EBITDA improving by a cool $7.4 million from last year. That actually swung the company into the black to a positive $5.8 million. That's the kind of operational leverage that gets investors really excited.
And get this, they did all of that while also cutting costs. They sliced $2.6 million off their quarterly operating expenses compared to last year. So let's just recap. Margins are expanding, profits, or EBITDA, are growing, and costs are falling. That, my friends, is the holy trinity of a successful turnaround.
Now, stuff like this doesn't happen by accident, right? This was all part of a very deliberate plan. First, they did a big SKU rationalization. Basically, they cleaned house and got rid of less profitable products. Then they launched a new specialty brand, SumOne, which should have better margins. And here's the kicker. They formed a special committee on the board to look at strategic alternatives. Whenever investors hear that phrase, their ears perk up, because it can mean anything from a sale to a major partnership. And you don't have to take my word for it. The CEO, John Moore, he said it himself on the call. He called it a pivot. He basically said, look, the hard part, the messy cleanup, that's done. Now it's all about performance, it's all about execution, it's all about growth.
Okay, so everything's looking rosy, right? The turnaround is working, the stock is flying, but hold on. Just as everyone was celebrating, management stepped in and basically poured a little cold water on the party. They were very clear, very direct about some big challenges coming up in fiscal 2026, and this is where the story gets a lot trickier. So what's the big problem? It comes down to one thing, the cost of green coffee. The unroasted beans. That's their #1 raw material, and management made it super clear on the call that prices are going up. And when your main ingredient gets more expensive, guess what? It's going to squeeze your profits.
And they even put a number on it, which is pretty direct. They're basically saying that beautiful 44.9% gross margin we just celebrated, yeah, that's not going to last. They're guiding for it to fall back into the high 30s next year. That's a serious drop, and it's a headwind you just can't ignore.
And to make things even tougher, it's not just about the cost of coffee. The amount of coffee they're selling is also down. Total volumes dropped about 10% from last year. So think about that combo. You're selling less stuff, and the stuff you are selling is less profitable. That is a recipe for a very challenging year. So let's step back. How do we make sense of all this for our final take? On one hand, you've got a company that has just proven they can execute. The turnaround has been impressive. But on the other hand, they're staring down a pretty significant, well-defined challenge. It's a real tug-of-war, a classic balancing act for an analyst. So if we were to put this on a scorecard, here's how it looks. The Q4 execution, that's a big green check mark, a definite positive. That margin expansion and EBITDA growth, you just can't argue with it. But that outlook for next year, you have to be cautious. Management told us themselves that things are going to get tough. The overall strategy, though, we'll give that a positive too. Finishing the turnaround and shifting to growth is absolutely the right call.
So, where does that leave us? Our official rating on Farmer Brothers is going to be market perform. And it really reflects that balance we've been talking about. We have to give them huge credit for the incredible operational work they've done. The turnaround is real. But at the same time, we can't just ignore the very real company-confirmed headwinds that are coming straight at them next year.
All right, and now it's time for my favorite part, the next call. This is where we throw out a wild but plausible trade idea, something you might see cooked up in a hedge fund strategy meeting.
So the idea today is a classic pairs trade. You'd go long on Farmer Brothers, but at the same time, you'd short a big consumer staples ETF, something like the XLP. Now, what's the thinking here? Well, you're trying to isolate the company's story from the broader market. The bet is that Farmer Brothers' specific execution, their turnaround, that new brand, and whatever that strategy committee comes up with will be strong enough to make them outperform the rest of the consumer staples sector, which is kind of struggling with a softer consumer. You're basically betting on this one company's story against the sector's macro story.
It's a really interesting setup, right? Pitting a single company's execution against the big picture trends. Pretty cool. And as always, remember, this is not financial advice.